Okay, I think maybe it's time now to transition to POL. Kenton, I'm going to put what Max has said on the screen. POL 30%. Go,
30%.
go,
Love
go,
it.
go.
Love it, Max.
Woo!
So
I'm all about that, son.
yeah, I'm not really seeing anyone else talk about it. Maybe we all already agree. Um, but just to recap and remind people if they didn't listen last week, we on is it ADR 28th, the recovery from the exploit. I think I think in the ADR it says 7.5% POL, 2.5% burn. But then everyone keeps telling me that, well, we'll talk about these numbers later and we'll adjust them after the fact. Um, I'm happy to leave the burn at 5%. I'm happy to move it to 0. I'm not going to push either way. I'll let the community decide on that one. I feel very strongly we got to go to at least 25% on the POL. Um, so we need to get back in balance. The fees going to nodes versus fees going to the pools. We've had, I want to say 8 months now. The fees have been slammed towards nodes because like the incentive pendulum is basically broken. It doesn't work anymore now that we removed the hard cap. And so we're perpetually over the cap. So the pendulum has fees going towards nodes, which feels great as a node operator and bond provider because we make more money. Great. But we can't grow. The pools aren't getting growing. We need the pools to grow. Like Chad mentioned earlier, the bigger the dollar value of the pools, the harder they are to move to ARB, means more trading, means more fees. Like we need liquidity, right? To have more fees.
Kenton, we have some people who are new watching this. What is the POL? Maybe just take a
Oh,
second
sorry,
to explain.
protocol owned liquidity. So yeah, you're right. So originally we had fees going to liquidity pools to encourage people to deposit their own money into the pools so they could earn fees. And that's how we would grow our liquidity. Um, the 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 capital of crypto that people are trading against. And the bigger that is, the bigger the trades we can handle, the more fees we collect. But now those pools are getting no fees. So there's no reason for anyone to deposit any money into the pools. So the pools are just stagnating or shrinking. And we want them to grow. And so we can either fix the incentive pendulum so that we start sending fees to the liquidity providers again, which I think we all generally kind of agree it's just not enough to incentivize people to deposit into the pools with the synths on some of these pools and screwing up the LP returns. It's a math nightmare. Um, so what we've kind of, I think, generally seems like the community is generally on board is instead of sending the fees to liquidity providers, the protocol keeps those fees but deposits it into the pool itself and starts becoming an owner of the liquidity pool. So protocol and liquidity. And this is liquidity in the pool that will never be withdrawn. It's there forever, owned by the protocol, which I really like. I like that because it makes us more stable and it should make the pools more stable. And talking about the synth leverage, we have a lot of legacy LP providers who have been through hell hanging on for years now who are basically like they're wiped out, they're underwater. As soon as they get back to even, they're yanking, maybe even 50%, whatever. As soon as they're up some amount, they're going to withdraw. We need to replace that liquidity, right? What are we replacing it with? And like, um, the simple, easiest answer is a protocol and liquidity. We don't have to worry about trying to go and raise money and convince people to deposit in the pool. We're just doing it already. And
Every block.
every block, and it just happens naturally. And then these pools can just keep growing. The more fees we are, the bigger the pools. The more fees, bigger the pools. Maybe this is how we kickstart the liquidity black hole again. Um,
Yeah,
but
I'm
bigger
starting to imagine that.
POL. Oh, go ahead, read it.
Oh,
Denny.
one. He says, let me bring it up again. Says with bigger POL protocol and liquidity tomorrow, 1% burn could easily be bigger than the 5% burn yesterday. Let that sink in. Very true, because the
Yeah.
liquidity, because be deeper, more arbitrage volume alone, right? I mean, yeah, there's a lot of compounding effects.
Yeah.
Chad, what do you think? What are you thinking about the percentage for POL? Where do you stand on that?
Um, I see it maybe a little bit more in more gray kind of way personally. So the um the incentive pendulum is not entirely it's working as designed, right? Like it's
Yes.
like we have too much of things we're securing and not enough security, right? That is working specifically as it's designed to incentivize. The idea is to incentivize either have LPs leave in a normal circumstance that would happen, right? But but if you're underwater on your LP position or it's worth close to zero, then like there's no reason to withdraw really,
Yeah.
right?
All
Like
right.
um, that's the first thing. If we get into a bear market, let's imagine that later in 26 we go into a bull market, not a bear market. Then as I would suspect, as it historically is true, that Rune would outperform Bitcoin and Ethereum just because it's a smaller market cap asset than larger market cap assets, and the incentive pendulum would be working again. Right, if Rune goes to $5 or $10, whatever the number, I'm not sure what the number would be, but whatever number it is, then that would shift, and there would be more security than assets, right? And the pendulum would swing towards the pools in a matter of speaking. And also, the other kind of color I would add is that like 30% now is what is 30% in a month right now? I would guesstimate that to be what, like 300K, 400K, something like this. I don't know if kind of even idea of what is the marketing makes 5%, right? So what is 5% right now?
I think we get maybe around 40 or 50 grand a month.
Yeah, so
So
40.
That'd be a lot.
Let's call it 50. And if it's 25%, that's like $250,000-$300,000 or in that range, right? But you get into a bull market, right? That number is going to be. I would expect, without having any crystal balls to speak of, but I would suspect that number would be a lot significantly higher, right? A lot higher, and so then you'd be generating a lot of money for the pools, which is that's also good too. But we could get to a place where, in that hypothetical future, where like we say 30% is actually maybe it's too much. In that scenario where we're in a bull market, it's generating, not just hundreds of thousands, but millions of dollars per month, right? And then maybe the nodes can vote again and say, okay, let's go from 30% to 15% or something like this, right?
That's really Yeah, that's a
Uh,
cool idea. Like if you had a new chain, right, Chad? Like if we could be so high, like you get a new chain. Let's say Quai is this new community. We just met them. They add and say, hey, you could just throw 25K in the pool, and then with the POL alone, if we like slung it, like we could get a really good depth, like super quick. And
yeah,
so their commitment to depositing LP and withdrawing the LP could be like the time frame could be really short
could
if
be
when we
really
get to
short
that point.
in that
How cool
scenario.
would that be?
Yeah. Um, and I think like, I mean, this is kind of like in the back of my mind, one of my kind of devious plans, so to speak, is that like, the dev fund right now is getting 5% and the marketing fund's getting 5%, which right now is just like, it's 40, 50 grand a month, something like this, which is, not anywhere close to the amount of money that we spend on dev, that the treasury is, is supplying more funds in that kind of context. But in a hypothetical future, when we go into some bull market later this year or next year or whatever the next bull market's going to be, then that 5% is actually going to be a lot more money. And when we go to the next bear market after the bull market, the dev fund will have a stockpile of cash, to help us get through the bear markets where you're not making as much. And so my hope is that, while the 5% now is not very much, after the bull market, it should be a lot, and enough money to supply the devs what they need to actually support the ecosystem as a whole, hopefully, right? And that 5% is probably maybe the correct number. Now, I would, in order to actually support the devs 100%, for the dev fund, we would need to increase that number to like 25% or whatever, something like this. But I'm not asking for that. I'm not advocating for that in this moment. I think 5% is fine for right now. We have the treasury. Treasury can support us easily for years to come. I'm not trying to push that on that yet, but my hope is that after the next bull market, the dev funds could be flush with enough cash to get through the next bear market, and then the treasury can more or less just kind of go away, and the protocol can become self-sufficient without some sort of external entity being the treasury to fund all of its interests, and capital and all these things. And so, and I think the same thing, marketing's not making a lot of money right now, but in the future they could be making significantly more, and they could spend that money on, I don't know, KOLs or whatever, ads or whatever the right thing is. I know zero about marketing, so don't ask me what it should be on. But, and so the 25, my point is that the 25% or 30% is probably like a correct number today, but I would submit that it would be too much in a more bullish market. But I think setting for now for 25 or 30% for the time being is probably enough. As Kenton has said in the past, if an operator is not making enough money to cover their basis, they can increase their fees from 20 bips to 30 bips or whatever the appropriate number of bips would be for that operator. Don't have much of a problem with that. And then once we move towards a opt-in chain security, which is still on the roadmap for later this year, that would make it a lot cheaper for operators to operate and to make more strategic decisions about which chains they want to support or not support, to make it, more optimal, to find more optimal kind of investment strategies or operational strategies rather, to be able to, to maximum output, in terms of how an operator operates, and especially compared against other operators who want to get bond providers, and they want the highest yield possible to get bond providers, but it costs money and all that kind of stuff, right? So I'm fine with a 25% or a 30% if operators are okay with that.
So like, but if we go into a bull market and in theory, is plausible Rune can outperform, then we get way over bonded. And the way the pendulum would work is nodes would get less yield and even more yield would go to the pools.
Correct.
So, but you just said we may not need that much POL or, yield going towards pools. So then where does it go? We go back to the nodes. And so like, for me, I kind of like, because we're moving away from the hard cap, we're moving away from economic security, right? And so that's why I like the idea of fixing the fees towards nodes, fixing the fees toward the pools, because then the size of the bonded rare and the size of the pools can fluctuate. The fee split is fixed, and the size of the pools and nodes can fluctuate better. Because I would think in a bull market, we want to maintain like healthy yield going to the nodes. We want more node operators. We want to get more nodes in the network.
Yeah.
Um,
But nodes would be making a boatload of money. And that's, I mean, a single node would be making potentially multi-millions in a month, potentially.
yeah.
Right. In that scenario, if that scenario comes up or whatever. But you could also make the argument that, like, if you don't want the LPs to leave, you were talking about the LPs, Rune gets to $5 or whatever, and LPs start to leave, right? If you kill the incentive pendulum, then yes, they're probably going to leave because the POL is not giving yield to the LPs. The POL is giving yield to the POL, right? And so if you don't want LPs to leave, then give them a yield, right? And so the incentive pendulum kind of has to stick around for that purpose, right? To ensure that LPs are at least have some incentive to stick around because, in effect, in that moment, they've been made whole again to some degree, right? Because the Rune price is back up or whatever. It's generating more money because we're in a bullish market or so. And maybe they want to stick around and continue to earn yield, or maybe they don't. Maybe they want to withdraw, and if they want to withdraw, they should be able to withdraw, in my opinion. But the question is, like, do we want to create the incentive as a community and as a protocol to keep them around, or just say, don't really care, don't really care, and incentivize you to stick around or to leave? We're leaning on the POL these days. We don't really care about, um, um, what's it called? the name of it, but like we don't want to pay for capital to be around, right? Mercenary capital is the word I'm looking for. Mercenary capital. We don't really care about that. The POL is the answer, and we're just gonna go all in on the POL mentality and just have the money go in and just never come out effectively.
As an
I
LP, sorry,
go
Kenton,
ahead.
go ahead.
Go ahead, Denny.
Oh, okay. Well, as an LP, I'm one of those people. That's why I laughed earlier, guys. I thought, well, maybe I shouldn't laugh, but I laughed because I am one of those people. Okay. So, I've talked with so many LPs. LPs have been great. I mean, just to do a little history, brief history check. When THORChain had a rough moment in 2021, right, during ChaosNet, we were paused, right, and we went back online. The LPs did not withdraw, and they stayed in there, they stayed true, they believed in the mission. So we love our LPs 100%. In my opinion, I think the LP model, I think it can work 100%, but to me, based on everything that's happened, I think it's much more cognitively easy to have a POL model only. And I think it's ultimately more secure because it's so predictable. And like when you have a fixed number going to POL, you can mod it. Like the depth is just always going to increase, right? And you don't have
Yep.
the ambiguity of worrying about someone withdrawing their liquidity. Now they could add their liquidity, of course, as you mentioned, but to me, it seems so much easier to calculate and to educate someone on the third parties. Like if you want to earn yield, you have to acquire Rune and either become a bond provider and bond to a node like Kenton, like so many other people, or you can take the opportunity to become a node operator, which many people are doing currently. I think that model just seems much more stable and feeds more into our ethos of no third-party contingencies. Now, nodes are third parties, but they're directly incentivized to function, in a way that's good for the protocol. LPs can come and go. They're more mercenary, I guess is the word. I really like the idea of POL. I think it makes everything simpler. And as someone who's pretty much switched entirely to being a bond provider, I can't go back to being an LP after being a bond provider. It's just, to me, just is so much easier, so much simpler. I don't have to worry about what prices are going to dynamically do in relation to each other. I got my node operator. I'm with Kenton, for example, one of my node operators. I like Kenton. He does a good job, blah, 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 blah. It works. And I think that's my opinion on it. I think it's just a better model, but Kenton, you were going to say something. Go ahead.
Yeah, I understand where Chad's going. And why should we incentivize the LPs to leave? Right? We should want to incentivize them to stay. We want liquidity. So that makes sense. Maybe I was thinking maybe one scenario is we go this POL route for a year or two type thing, and we get the pools get POL grows quite a bit. Room price gets to $5, whatever the number is that all the LPs are back to even. And then we're like, okay, now we can, now we should get rid of the synths, right? And let's remove the synth leverage. Let's cancel it out. And then maybe at that time, we're like, okay, we're going to stop fees going to POL. We'll go back to fees going to liquidity providers. The POL is going to be a liquidity provider, so it will continue to collect fees on its pro rata, and then so will the other LPs. So that might encourage them to stay. I'd be honest, I'd be shocked if anybody stays. I can't imagine we can't. There's I don't think there's enough fees in the world to keep.
I think more will
these
stay
guys.
than you think, just because I think for some people, for some percentage, who are LPs, they've written it off. In their minds, it's gone, and they're done, and they exited. They're not even listening to this podcast right now.
Yeah,
right?
yeah.
They,
That's true.
they've exited. They gave up on THORChain, 2 years ago or a year ago, whatever the number is, and they're out, right? And to them, their position is gone, right? And so it will just sit there basically forever because they just forgot that it even exists to begin with.
Yeah. But when they do remember, or they
If they
just,
remember.
if they remember, but let's say, if they don't remember, we don't have to worry. Why give them fees?
Right.
They forgot about it.
Right.
Right.
They're not going to do anything. You can't convince them to leave, and you can't convince them to stay. You can't convince them to do anything.
They just forgot about it.
Because
But
they're
let's
not
say,
even going
hey,
to listen to this podcast or anything like it.
But
That's
I think
funny.
the most plausible, most likely scenario is, like you said, Chad, people just kind of writing it off, giving it up. The bull market will come back, and then we all kind of go looking through our old wallets, whatever. And, oh, I remember that project. I'll go check it out. And they're going to see their LP position at, oh, hey, it's back up. I'm only 20% underwater. You know what? This is great. I'm going to take it, better than nothing, get on with my life. No hard feelings. But we've just been paying them X percent of fees over the last several months, only for them just to yank it. And I feel pretty strongly, like knowing human nature, that's what people just hold on to break even, then they leave. And like no amount of yield or promises or code change is gonna like convince them. And so to me, if we want to get yield back onto LPs, it's to attract brand new ones. And then I think that's the conversation we have to have. Is that actually the model we want to go after? And I don't think so. I think POL is much better because it's just look at the current LPs. Like a lot of people shouldn't have done it in the first place. Like they just didn't understand the risks. And TCB has talked about this so many times that like liquidity pools in general in crypto just do not make money. Like it's just not like very few pools or very few people actually make money providing liquidity.
Yeah, the only
And
people who make money, not the only people, but is in a concentrated liquidity system, you are running a bot, and you're one of the top 2% people running a bot, and those people can make money in AMMs. Everybody else kind of gets the shaft in one form or another. And that's
yeah,
true with Uniswap, from what I understand. That's true with Osmosis, from what I understand. Um, I think for us in the beginning days of THORChain's history, when AMMs were kind of new, right? Like
Right.
Bancor was the first AMM I've ever recall, and they launched maybe I want to say 6 months before we did, or maybe a year at most. And so we didn't like have all the data then, right, about what AMMs were or were not, and how they worked over a long period of time between bull markets and bear markets and all the different things. And we tried to use all sorts of like clever kind of tricks, so to speak, not tricks, but literally, but just kind of ideas like impermanent loss protection was one of the earliest forms of this, right? Where we would protect the downside to convince people
Right.
to add liquidity, and we thought because of our CLP, our mathematics is a more fee generation than what Uniswap was using at the time, or Bangor, that it would be more profitable on THORChain than it would be on our competitors. I think it's actually, to be honest, I think that was still true relative to other competitors. It was still more profitable than other AMMs for a host of reasons. But I think myself and JP, like over the years, have kind of come around to like it's really hard. Like the nice thing about LPs is that it's capital that comes in very quickly. The POL is something that builds slowly over a long period of time, and when you're building a protocol, you don't really want to have liquidity next year. You want to have liquidity this year, and that's like the fastest way to achieve that is through AMMs, and people have become LPs, and that makes a whole lot of sense, in that context. But I think like it's much better, it's much a stronger position for the protocol itself to have to own its own liquidity. And I think the first entity to kind of do this that I can recall at least was, I think it was called Zeus, or something like this. Do you remember that from like 2021? It was something called
Vaguely.
Oh My Zeus, or let me see if I can find it. It was a protocol that went crazy popular. It was like all in the news. I want to say it was Zeus or something close to that. And it was buying its own liquidity. Every time you bought the Zeus token, it would buy its own liquidity, and it would permanently stay in the pools. It eventually exploded because they were saying, "Oh, buying Zeus will give you 1,200% APYs," or the most obnoxiously false claims, or whatever it was at the time. But from an investor perspective, having LPs is actually a risk because your liquidity can fly away at any time. You know what I mean? And so
Right.
I
And
think
we
I've come around to the idea that like I think probably POL is probably the best way to move forward going forward.
we want people who interact with THORChain to have a positive experience. And if everyone who LPs just ends up losing money, it's a negative experience. They complain. They're out there talking about it. Don't touch that thing, whatever. Like, we want the market, the community, the public to be confident. When they interact with THORChain, this benefits my life. All right, I'm gonna be a bond provider. I'm gonna get a benefit of it. I'm gonna trade on THORChain. I'm gonna benefit. Everyone goes in these pools thinking they're gonna benefit, and if everyone ends up losing, it's like it just doesn't. We're not. It's very short-sighted, short-termism. Like, we're just okay. We're getting some dollars out of these guys, but the reputational damage is just not worth it. Um, and the protocol can bear that cost, right? That burden. Um, you mentioned you're totally right, Chad, about if with having an LPs open for anybody, we could get millions of dollars all at once,
Mhm.
whereas it could take us a year to get that from this POL. But we're already starting with a huge chunk of POL. Like, the protocol already owns, I think, basically all of the liquidity right now. It's like $50 million or something.
Right.
Um, and then because of your hard work, ingenuity, you've made THORChain that much more capital efficient. So before, when we thought we needed billions of dollars of liquidity to handle all these trades, now we only need millions of dollars of liquidity to handle all these trades.
Mhm.
And so even with the little liquidity we currently have, we did a $32 million Bitcoin trade a few months ago, the biggest Bitcoin trade in DeFi history. So, like, and we can already trade a trade larger than the pool itself. If we got a pool that's $1 million,
Yes.
you can do a $2 million trade on that
Yeah, you
pool.
can do a $10 million trade.
Yeah. So, like, um, and that's only going to improve with rapid swaps and limit orders and stuff. So, um, the need for our liquidity is less. And so we can get our dollars in liquidity go a lot further now. So I don't see that as being a big risk about us getting, having enough liquidity. Um, actually, but to be honest, I see the risk. Like, for example, Monero. Where's the liquidity going to come from in the Monero pool? Yeah, okay, it's going to be seeded with 25, 50 grand, but this pool should be millions of dollars deep, right? We're all excited about it. Treasury's limited, right? You guys can't put the whole treasury into the Monero pool, right? Doesn't make any sense. I think everyone can generally agree. So who's going to who's going to add to it? Where's it going to come from? And it's got to come from somewhere. So
Yeah.
if we can get POL and just get this XMR pool up to a few hundred grand, 500 grand as soon as we can, um, then yeah, I think I'm inclined to think everyone would agree that'd be our priority. Get the
Yeah.
Monero pool as big as we can, as quickly as we can. Um, yeah.
Well, I was thinking, what do we want to attract? And just to back it up a little, for people who are watching, what THORChain is just raw neutral infrastructure. That's what it is. And when we started in 2021, you have infrastructure that is decentralized, permissionless, no KYC. What should the incentive structure? A lot of thought has been put into it, and we've really changed and morphed over the years about what works and what doesn't. I mean, this is literally, we're inventing economic doctrine here. That's what we have essentially done. We have invented an entirely new economic doctrine that has never existed in the history of our species due to the advancements of blockchain technology. This is what it's incredible, right? So what do I want to attract? I actually want to attract developers long term. So so my short term POL really high, get lots of liquidity in there, boom, 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 make things deep, make things great. But because we are so capital efficient, thanks to people like Chad with all the various advancements, what's going to come next? Well, we want to add all these different chains. And to back it up a little bit more, right now, every node operator has to run every single daemon of every single chain that we support, or they will get slashed. That's how it's going to be. But if we in transition to a opt-in chain client, what my mind does is like, well, okay, then we can scale to almost all the chains, maybe. You're right. So then what does that mean? That means we have a scalability issue on the developer side because all of these chains are going to need to be maintained. So I think short term, what my gut says is, okay, 30% POL, 25%, 20, whatever it is, we get liquidity, we're healthy, we're rolling. We're going to need more developers. We're going to need more maintenance staff. So then you maybe go to the development fund 10%, 12.5%, right?
I'm actually
maybe the
hoping
yield is so good that the
that
marketing
Hugin
fund
does
goes to
all that
10%.
long term.
Yeah.
Pardon? What'd you say, Chad?
Hugin,
My hope
AI.
is that like the problem with going with many chains is that like especially younger chains tend to be more unstable than older chains, right? And so when you start adding, take was it Quay or Quai? I don't pronounce it correctly.
Why?
Or like these, like not that I'm picking on them by any stretch by the mention, but I have no nothing. I know nothing about their stability, but like if they're a more unstable chain, it's expensive from us from a developer perspective. They're doing more updates more frequently, like how many updates per quarter or month or whatever it is. Like that takes time for developers to pull in the updates and
Gaia.
Gaia, like all of these things, it is a cost on us from a developer resources perspective, and it becomes harder and harder to maintain uptime on the chains because we have so many chains, and if any one of these chains have problems or whatever, then that chain no longer trades, and it just becomes a constant thing of problems. And so my hope long term, I don't think we're there yet, my hope is that Hugin becomes a fully autonomous developer that can maintain the chain clients for us, in an autonomous way, so that so we can do that work without actually doing that work, in a sense.
Yeah, because if one thing goes down, we can't churn, right? If one single chain
Correct.
F's up, we literally cannot churn and rotate vaults. And so
Correct.
that's a pain point for sure.
It's a pain
So,
point. Yep. Right.
Yeah. Um, yeah. Yeah. I think
Singing,
AI is the way, the future. It's gotta be.